Hey guys, so I want to go through the November monthly chart pack. Now, it's been a little while since I've done one of these videos where I kind of just walk through the chart pack and some of the information and data that it's been revealing. I try not to sneak peek, look at these things before I go through these sessions, just so I can sort of understand and read the data at the same time that you guys have. But I had a quick look yesterday, which sort of enticed me to jump back in and do these sort of walkthroughs. But a lot of things have changed since the last time I viewed one of these monthly chart pack reports, and it's a pretty interesting time in the market and some really interesting insights that I sort of want to go through. So hopefully we can go through them today, and I want this to become more of a regular thing. Obviously, we'll jump in and do the Corelogic one every month. Now, I'm not sponsored by any of the companies reports that I walk through. I'm just generally interested in the data and having a look at what they mean and look like. But yeah, I want to sort of walk through a number of different reports from some of the major industry leaders and unpack some of the information that's in them. So we'll go through them together. Hopefully the format of the way this PDF is broken down is looking all right for you guys, but I'll walk through it on my end. So residential real estate underpins Australia's wealth. The residential real estate industry is now a $9.3 trillion industry. That's up from like 7.8 trillion last time I read, or something like that. As you can tell, it's been a little while, but that was less than 12 months ago, probably a little bit longer, but it's increased pretty significantly since the last time I've read this. When you compare that to, superannuation at 3.3 trillion or listed stocks at 2.8 trillion, it's quite minuscule compared to the other investment classes that are out there. Number of dwellings is 10.7 million. Outstanding mortgage debt is 2 trillion. So that number is always such a big emphasis to me. If we just do the quick maths on what the national LVR is, when you comparing a $2 trillion debt by a $9.3 trillion industry, it means nationally we've got an LVR of 21% there, Australia wide. So, loan to value ratios across the country is quite significantly. I mean, there's a lot of old money in a lot of that real estate, and, a lot of people would sort of, it'll be much heavily geared to the higher end, and there'll be a lot of people where that $2 trillion worth of debt is quite intensely focused. But when you think of it on a national scale, it's actually quite low. What else have we got here? Household wealth held in housing at 55%. So yeah, 55% of all wealth is held within housing. Again, that's a crazy number. Sales per annum is 610,000. It'd be interesting to see how that shift is year on year. Obviously, we're just going through second round of COVID, lockdowns, everything else like that. And then the gross value of transactions is 448 billion. I might even do a video where I come back and look at all these numbers back in time. There's probably a chart in here actually that breaks it down, but yeah, it's pretty phenomenal. Australian dwelling values overview. So over the last 3 months, it's increased by 4.6%. National home values rose 4.6% in 3 months to October, which has eased from 5.9% increase into the 3 months into July. So slowing down a little bit there in terms of growth. 12 months, we're up 21.6%. That's crazy. Australian dwelling values are 21.6% higher over the past 12 months, which is the highest annual appreciation since June 1989. I was born in 1992, so I can give you a bit of concept around how long it's nearly a 30-year cycle, longer, 32-year cycle since a peak of growth or a peak of appreciation. And then capital cities, so high end of the market is leading the growth. In the 3 months to October, the top 25% of values across the capital cities rose 5.2% compared to 2.8% across the lowest 25 percentile. So all we're saying there is that the lower sort of valued properties have only increased at 2.8%, where the higher end have increased by 5.2%. So 3 month change, we're at 4.6 nationally, regionals of 5.3%, combined capitals of 4.4%. And then interestingly here, we've got quite a rise coming into the end of 2020. And then we've had quite a downturn since 2020 in terms of quarterly change. So the growth is starting to come down on a quarterly basis. And what is interesting is, these peaks and troughs over the last sort of 5 years have been quite aggressive. Where if you compare that back to sort of between 2010 to start of 2015, there the ups and downs have been not as aggressive, and so it's going to be interesting what happens on this one. What is interesting is we're seeing a tick up on the combined rest of state this month. I don't know if I can, so there's a tick up last month, which is interesting, which, when you sort of look at this chart, you can sort of see, well, the trajectory is down, but we are ticking up a little bit here. And generally, if we look at the past, when there's a tick up, there's a bit of a trend over the next sort of 3 or 4 quarters following that. So it could be a tick up in trend, but be interesting to watch. 12-month changes. So this is more on an annualized basis, sort of looking sort of a little bit more intensely in 3-month rolling gaps. Now we're looking at a 12-month rolling gap. So we can really start to see on the 12-month chart that the lines are really starting to just turn over now. Obviously, historically, this is a lot more smoother. These lines moving up and down, the combined capitals and rest of state. They're a lot more smoother in their ups and downs, and we're just starting to turn down the speed a little bit here. So haven't taken the turn yet, but that'll be quite interesting to watch. A bit of a slowdown there. I doubt it's going to. I personally, well, I don't know, but to continue on the trajectory that it has been going is pretty phenomenal. Good to see that there has been a little bit of a slowdown, but nothing, detrimentally reducing there. And then Australian dwelling values, capital cities. So lowest one on here is Melbourne at 3%. Good on Melbourne. And the highest is Brisbane at 6.5%. That makes a lot of sense, right? Melbourne's been in multiple lockdowns for a long period of time, where Brisbane, had the Olympics boom. Everyone's kind of migrating over there with international or interstate migration, I should say. I don't know the specific numbers, but there was like 20 to 40,000 people from both Sydney and Melbourne who moved interstate to Brisbane or to Queensland over that period. So interesting to see there that the prices have increased. Obviously, you've got investors and everything else to take into consideration as well. But leading the charge on the right-hand side here and overall is actually Hobart at 6.7%. And then we've got the ACT there at 6.2% as well. And Perth and Darwin are quite low over here as well. Australian dwelling values, capital cities. So this is the lower 25th percent quartile to the 50th to the 75th percent quartile. And so you can see Sydney, Melbourne, Brisbane, Adelaide. So the major capital cities that have performed quite well over the last 12 months. You can see that the higher 75th percent quartile has been the main primary driver of the rest of these lower 50 and 25th percentile. So the higher end of the market is really driving those prices. In Perth, we're quite slow around. In Hobart, it's the reverse. It's the lower 25% quartile that's increasing or driving the prices, which is quite interesting, right? What might be the cause of that? And I don't know, the market specifically over that is, you might have a bunch of dwellings that are under the average, and the incomes have increased over there quite dramatically, and that's pushing up that lower end of the market. That I know that the higher end of the market has had quite a drive over the last, since 2017, and so it might be that the lower end of the market over there is now increasing or catching up, I should say, to that higher end of the market. So quite interesting to see, and to see if that trend will continue in the rest of these states as the lower end of the market starts to catch up to the higher end of the market. You can't have let's say a 3-bedroom house in one area that's worth $1 million and a 2-bedroom townhouse that's worth $500,000, because bang for buck, you're probably going to go for the $500,000. And so that's why in the scenario that the lower end of the market will increase at a higher rate. And then ACT is probably pretty standard over the board there. So housing cycles now in capital cities. We've got the rolling 28-day growth rate in Corelogic Home Value Index. So the 28-day change in Hedonic Home Value Index trending down through the second half of October, having stabilized a little through September and the first half of October. Through October, high levels of newly advanced stock, affordability constraints, and announcement changes to lending conditions may have contributed to an easing in the growth rate. So this is the Hedonic Index that Christopher Joy has famously put together. And we're on a sort of a downward trend here. You know, we're looking at 07 June or May 31st as a bit of a start, and we've had a bit of a roll down. We had a little bit of tick up in September. Now we're starting to come back down. So we're still in positive growth territory. However, the growth has slowly come down from 2.2% down to 1.2% over, you know, a 28-day rate. So that's interesting. So housing cycles in Sydney. So in October, Sydney dwelling values increased by 1.5%. The quarter was 5.2%, and the past year has been 25%. Sydney dwelling values are currently at a record high. Crazy when you start to see where this, you know, trajectory is really heading. We're coming down to this smoother period now on the annual change. And the quarterly growth is starting to come down as well quite significantly, a trend on that quarterly change of coming down. So interesting to see what happens in Sydney moving forward. Same with Melbourne. We rose by 1% in the month. Quarters is at 3% now. We're on that same downward trajectory. In the past year, it's increased by 16.4%. Pretty interesting there. Brisbane, however, is still on the rise and steadily on the rise. You know, when we look at this month-on-month chart in Brisbane, it's pretty much been the same since the last six to 7 months has been around the same sort of point there of 2.5%, 2 to 2.5%. So growing quite consistently at 2%. We're up 2.5% on the quarter. On the month. On the quarter, it's 6.5%. In the past year, it's been 22.3%. So that's interesting to see. Brisbane has actually been a little bit slower than Sydney. Sydney was 25.2% and started with some big growth, you know, 7 months ago, and which has slowed down since. Whereas Brisbane's been a little bit more steady and continuing to grow there. Adelaide cycle, again, we sort of see that peak coming into play there. October and Adelaide prices. Dwelling values rose at 2%. In the quarter was 5.9%. In the past year, it's increased by 20%. Again, that's been actually quite steady compared to Sydney and Melbourne, ranging between sort of 2 and about 2% there, month on month for the last 6 months of the quarterly change. Perth is on a big trajectory down, falls of negative 0.1%, so not huge, but we are on the downward trajectory. In the quarter, dwelling values have increased by 0.6%. In the past year, dwelling values have increased by 16.4%. So you can see that quarter-on-quarter change is coming down quite dramatically, potentially looking at getting into the negative area at some point too. Perth dwelling values are now negative 2.6% below the record high, which was in June 2014. Now, we haven't looked at the previous ones of these. I do want to see this. Adelaide is at the current record high. Brisbane is at a current record high. Melbourne is at a current record high. And Sydney is at a current record high. So very interesting markets to watch at record high. Hobart's are at a record high. Hobart's had the most growth at 28.1% over the past year. October was another 2%, and in the quarter was 6.7%. A little bit more unstable here. I wouldn't say unstable. I mean, it's been quite consistent around that growth trajectory on the quarterly growth there. But in saying that, is a little bit more volatile in terms of it's not just a sort of flat line growth. Still looking quite strong with the Hobart annual change there. However, we are starting to see a little bit of a peak off trajectory to the side there. Darwin, we're on the downward trajectory here, although we did grow by 0.4% in the month. Quarter was 0.4%, in the past year has been 19.3%. Again, that last quarter is looking like it could potentially go negative next month. Canberra's up 1.9%. Quarterly values are at 6.2%. In the past year, dwelling values increased by 25.5%. So again, being quite stable here at the peaks. Canberra current values are at the record high, and Darwin values are now 15% less than the record high, which was in May 2014. So really struggling there for Darwin and Perth. But rest of the markets are at the peak of the market, or wouldn't say peak, but they're at the current record highs, and those trajectories are looking like they're starting to hit a bit of a cap apart from Brisbane. So be interesting to watch those markets. Sales and listings. So national sales volumes rose 42.4% in the 12 months to October, and the transaction volumes through the month of October were estimated to be 54.8% above the 5-year average at 60,948. So change in sales volumes regionally looks good. Hobart, Darwin looks pretty huge there with 71%. Australia-wide is 42.4%, combined regionals is 39.6%, and then combined capitals is 44.2%. But the real interesting thing is this graph on the right here. So the 5-year average is around 40,000. The monthly sales volumes almost peaked last month around, what did they say, 60,000. And then the 6-month rolling average is really, really high as well. So lots of transactions being held at this point in time. And I guess, there's a lot of pent up demand with lockdowns and everyone else potentially not being able to transact on properties. So naturally, I feel like that would have been quite high. Median days on market. So in the 3 months to October, Australian properties typically took 28 days to sell compared to 39 days over the same period in 2020. So days on market are really, really low at the moment. Think about a normal auction campaign. It's a 5-week process, or a month or 30 days, and properties are transacting within 29 days. So that's less than a typical marketing auction campaign, which is crazy to see, right? It means that properties are selling quite quickly, even prior to auction, or auctions are being brought forward to deal with that demand coming through. Combined regionals is at 31% and combined capitals is at 28%. So yeah, it's not the lowest. The lowest was sort of start of 2021 at about 20 days on market. But we are still quite low, and that is ticking up. So days on market is ticking up, which is quite interesting to see. Vendor discounting. So vendor discounting remains extremely tight nationally at negative 2.9% to the 3 months to October, compared to the negative 3.6% in the same period of 2020. So vendor discounting is just how much the vendors are willing to discount their property by. So in a really, really hot market, obviously vendors want to get the best property price that they can for their property. In a slower market, vendors are potentially happy to discount a little bit more so that they can get the sale done. So as they clearly demonstrated, vendor discounting remains extremely tight nationally. Discounting goes, the very bottom is around that negative 5% in sort of the start of 2019 there, which I think March 2019 was when the pandemic really came into play. Or maybe it was March 2020. Can't remember. I've been in lockdown for the last 18 months. So I don't know what's going on. But yeah, that's quite interesting to see. So new listings have trended higher through October as social distancing restrictions continue to ease in the spring selling season to see a seasonal uplift. Yeah, so as you can see here, guys, end of September, November is the spring selling season, and traditionally there's quite a lot of properties on the market. If we look at this dark purple line in 2021, it's quite normal. Previous years in 2029 and 2020 are really low. So it's quite normal compared to historic years when we don't have pandemic and lockdowns, which is quite good to see where the market is recovering to sort of its normal trajectory at that point in time based on historical information, not being in a lockdown and having a pandemic going through. However, total listings remain negative 26.1% below the 5-year average due to strong absorption from sales. Yeah, so essentially there's still a supply issue out there. Plenty of pent-up demand from people being in locked down for so long, either wanting to move interstate, being unable to travel or go overseas, potentially wanting to, buy somewhere else, buy a holiday home, look at getting into investments, all that sort of stuff. And that demand driver is really keeping the supply at bay. So at the moment, there might be some more supply coming on the market, but those demand drivers are really eating it up, which is essentially what they've just mentioned here. So down 20% is quite significant, especially even if we look at the 2019, 2020 lines, it's still ridiculously lower than that as well. And it has been that all year. So it's quite interesting to see. Total advertised stock remains lower than the equivalent period of 2020 across most regions, with the exception of Melbourne and Darwin. Total advertised stock remains lower than the equivalent. Yeah, okay. So no new listings changed from the equivalent period last year is up 23.8%. And then total listings change equivalent period from last year is down 20%. So new listings is up, which means there's more listings coming on the market. But compared to the total amount of listings, we're still down 20%. So there's a lot of listings coming on, but that's all getting eaten up by the demand, and we're still negative 20% compared to the total amount of listings on previous years. So weekly clearance rates, the combined capital city clearance rates saw a recent peak of 83.2% in the early October, but has since trended down against higher volumes. Auction volumes have surged since the easing of COVID-related restrictions. So number of auctions, auction clearance rate, and clearance rate 4-week average. So the 4-week average is obviously a much smoother transaction. We had quite a big peak. It's auction volumes. Is there a clearance rate percentage? Yeah, I kind of want to see clearance rate on the right-hand side. It's interesting that they do that. But yeah, auction clearance rates got down to like 60% prior to the spring selling season. Is that when lockdown 2 or 3 came in for Victoria as well? It'd be interesting to see. And then we peaked back up to a good 80% there at least, coming out of that. And then we're sort of, well above normal here anyway, with the clearance rates. So still a strong. We are trajectorying down though on the clearance rate, so they are starting to come down. Which again, there's a lot of indicators, guys, here that things are on the sort of peaking or coming down into the lower, coming down from a bit of a peak. So yeah, this data is actually quite interesting to delve into. Rental rates. So in the year to October, Australian rent values increased 9.2%, which is the strongest annual appreciation in rents since February 2008. So the annual change in rental rates, 9.2%. Oh my goodness, that's a big shift. So annual change in rental rates. So the highest, the previous peak was at 3%. It's now at 9.2%. What's a rental rate? In the year to October, Australian rent values increased by 9.2%. Okay, well, obviously that's off the back of, you don't really see rents coming down that significantly. Like there's not a huge rebound. But for rents to increase by 9.2%, and that's without any international migration, not any, but a strong international migration that are going to flood into the rental market, the rents are going to be quite interesting to watch when they do open the borders or the international borders up quite significantly, because that's a huge jump already coming out of lockdown. Why does that not impact on rental yields? So the gross rent yields continued to trend lower through October, reaching a fresh record of a low 3.27% nationally. Yeah, so what's essentially happening is the values of properties are increasing so dramatically. Rents are increasing, but I don't think, I think it must be coming out of lockdowns. There's not a lot of international migration. There's a lot of interstate migration though, which may be happening. Where's the biggest push? Darwin, Hobart, Perth, Melbourne makes sense because a lot of people are moving out of Melbourne. Sydney's quite high at 8.3. Brisbane's quite high at 10, which makes sense because a lot of people are moving there. So this is very interesting because as the prices of property, the reason the rental yields aren't coming up as aggressively is the values of property are increasing much faster than the rents are increasing. So the rental yield's actually coming down because the rents aren't increasing at 20% per year. Your rent's not going from $400 to $500 in a year, right? So you actually will see those rental yields come down, which makes sense. But yeah, that's very interesting. That's a really good insight. So 9.2%, the rents have appreciated, which is the strongest annual appreciation since February 2018. Yeah. My goodness. I actually want to delve into that and see what the main driver is. Where that push for rental prices is coming since October 20. Interesting. Might have to put my rents up. Dwelling approvals and housing credit. Yeah, so this is super interesting now that we don't have the what was it? The first home loan deposit scheme or the housing. What was the government grant that they put in for housing constructions, home builder or something like that? I don't know. But yeah, now that that's come down, approvals are coming down pretty significantly as well. So while house approvals surged over the home builder, that's what I was looking for, home builder, and an increase in the first home buyer participation through 2020, dwelling approval dynamics are shifting with demand in 2021. Unit approvals rose 17.4% in December against a negative 16.1% decline in housing approvals. So the monthly house versus unit approvals national. So the decade average for houses is around the 10,000, just under the 10,000 mark. That increased significantly to 16,000 and has now come back down to the decade average, which is great to see. Interestingly enough, units haven't increased that dramatically, but they are above the decade average as well now, which is interesting because I'm not a big fan of units. So yeah, housing approvals are coming down, unit approvals are going up. But construction is obviously in a bit of a tough situation with timber shortages and construction prices going up quite significantly as well. Finance and lending. So through September, the combined value of lending for purchase of housing fell negative 1.4%, taking total housing finance negative 5.4% lower through the 3 months to September. The monthly decline in secured finance was driven by a negative 2.7% decline in owner-occupier finance, while investor finance rose 1.4%. Yeah, so last time I read these charts, the investor finance was really lacking compared to the owner-occupier finance. So what that means is there's much more funding for people who are buying their own homes compared to investors who are looking to buy investment properties. And what we're seeing now is, firstly, there's a big tick down in owner-occupier financing and a big trajectory up for investors. Not a huge trajectory up, but it's on the rise. But on the right-hand side here, what we've got here is portion of new lending for investment housing. So this is a percentage compared, a percentage of who's going for lending for investment purposes or who's going for lending for owner-occupier purposes. And this is now coming back up to 31%. What I'm guessing this line is the national average of 35% here. So it's good to see that investors are starting to come back in the markets. Now they're not coming back in droves, but they are ticking back up, which is very interesting to see. Again, most states and territories have seen a proportional uplift in investor finance over the month, though there was a slight decline in New South Wales and Northern Territory. So what are we looking at here? New South Wales, bit of a decline for investor financing, and where else? Northern Territory. Yeah, bit of a tick down there. So that's interesting to see. But investors as a percentage of housing finance by state, it's really being driven by New South Wales at 34% there, closely followed by ACT, Tas, and Queensland and Victoria being the main drivers above 30% there. First home buyers. So first home buyer finance as a portion of total housing finance across Australia has increased slightly over the past 3 months, climbed to 26.3% of lending in September. This compares with a recent low of 25% 0.6% in July. Yeah, that's super interesting. So this is first home buyers as a portion of getting into the market. So it's at a maximum at 30% there. That's for WA. New South Wales is coming down. And what's this purple line? Victoria as well. So Victoria and New South Wales first home buyers are coming down. They sort of peaked here at, sort of 25, 30%. New South Wales is peaking at like 20%. And they're actually coming down, back down to sort of 15 for New South Wales and sort of 20% for Victoria there. I'm actually going to tell us the values here. So Victoria is 27% and New South Wales is 21%, which is very interesting to see because when you think about the affordability constraints for first home buyers to get into the market, these other markets are ticking up, like Tasmania is ticking up quite aggressively. WA there. The other market is ticking down. Is that Queensland or South Australia? South Australia, but Queensland's actually going up. So very, very interesting. The affordability constraints there really show you the markets that are taking a hit with first home buyers that are trying to get in there for owner occupier commitments. Very interesting to watch over the next couple of years. Then we've got the cash rate with the RBA. So the RBA held the rates at 0.1 through November. We've got some statement highlights here. So the cash rate target was held at 0.1%, and the interest rate on exchange settlement balances was maintained at 0.0%. Government bond purchases were capped at 4% billion per week. So they're literally printing $4 billion into the economy every single week. If you don't know what that means, is they're essentially not physically putting $100 bills in, but in a technological world, injecting an additional $4 billion into the economy out of thin air. So theoretically, in the way inflation works is, today's dollar is only worth $97 next year. So your $100 actually lose value over time, and this is why. Well, it's not the main reason why, but it's one of the contributors. Is they essentially just print money out of thin air, inject it into the economy, stimulates the economy, which is great because people keep spending, but the value of money actually becomes less and less over time. The RBA have abandoned a yield curve target of 10 basis points on the April 2024 bond. This was off the back of a reduced efficiency of the tool following a strong inflation result of the September quarter and high expectation that rates would lift sooner than 2024. Yeah, so the RBA have mentioned that they weren't going to increase interest rates by 2024. However, if we start to see replications of what New Zealand are doing, I mean, the New Zealand property market's gone bonkers over the last 18 months, and the government and the Federal Reserve over there have really stepped in to take hold of that. I think they increased interest rates by, I don't know the exact number, but wasn't dramatic, but it was like 1% or half a percent or something like that, which is quite dramatic, off a very low base. So they're really stepping in there to sort of try and slow down the property market. The biggest problem with, the cash rate is it impacts so many things: small business loans, the property market, loans for property, I should say, not the property market itself. And so access to finance is one of the biggest drivers of being able to increase the value of property over time. So if people stop getting access to finance, they're not going to be able to buy properties, and ultimately the demand for property is going to come down. So it's a very tough balancing act to get the cash rate right. It's at 0.1%, which is the lowest it's ever been since recorded here at 91. But potential increases in the cash rate prior to 2024 now. And then the last point here is the RBA flagged that the increase to the cash rate may still not occur until 2024, but it is now possible that an increase to the target could occur before this. Interesting. It was stated that the latest data and forecast did not warrant an increase in the cash rate through 2022. So potentially 2023, the cash rate might start to move. Record low mortgage rates. So the average new housing lending rates have declined 112 basis points for owner-occupier since mid-2019, but held steadily for new owner-occupier borrowers through September at 2.37%. Average investor rates declined 1 basis point through September to 2.71%. So mortgages are still on the downward trajectory here, and they have been since September 19. Investor new loans is... Do I get a clearer picture around this? Yeah. down here. So investor new loans below an 81% LVR is about 2.71%, which is good. For existing loans, it's 2.99%. So if you're getting a new loan, it's quite lower. Existing loans is 2.9. Owner occupiers, that's actually quite low. Owner occupiers are down to 2.36%. For new loans, and for existing loans it's 2.7. That's cheap, man. Money is very cheap at the moment. You can get a fixed 3-year or less loan for 1.99%. Craziness. I remember when my interest rate from my savings account was like 3.5%. Now you can get a loan for 1.99%. It's mental. Mortgage rate, so debt to income ratios of 6 or more jumped to 21.9% of new mortgage lending in the June quarter. So regulators and policymakers are closely monitoring lending standards. More recently, the banking regulator APRA has increased the serviceability assessment buffer rate from 2.5% basis points to 3.0% basis points. So when you go for a loan, if you don't know this, but if you say you did get demonstrated that 1.99% is, that's going to be your loan rate. Well, the banks actually have a different rate that they assess you at. So previously they used to increase it by 2.5% basis points. So you'd be assessed at, quick maths, 3.49. No. So 1.99. This is ridiculous. I've had a long day. 1.99 plus 2.5 is 4.49. So they would assess you being able to make those repayments at an interest rate of 4.49%, and they'd only give you that loan if you do pass that. Now they've increased it to 3 basis points. So you go from 1.99 to 3 is at 4.99. So now you're getting assessed at pretty much 5%, being able to make those repayments at a 5% interest rate per annum to be able to meet the serviceability requirements of that. And then some of the data that we've got here is percentage of loans for interest-only terms. So interest-only is down 17%. Percentage of loans originated with a loan-to-value ratio above 6%. So nearly 10% of all loans are above an income ratio of 6 times income, which is pretty crazy. And what's this next one? Percentage of loans originated with a debt to income ratio above 6%. Percentage of loans originated. A debt to income ratio above 6%. Okay. So loan, and now this is debt to income ratio above 6% is 21%. So 21% of loans are above a 6 times income debt ratio. That's mental. And then percentage of loans originated with an LVR above 90% is at 10%. That's pretty interesting to note. I thought there'd be more people who are going for a higher LVR, especially in the current conditions. Well, that's pretty much it, guys. That last one was actually pretty interesting. So very interesting. Hopefully that was insightful, guys. Sorry, it's been a bit of a long day and I sort of mumbled some of the numbers, but yeah, I really want to keep delving into these numbers. I think they're really important and keep us up to date and up to market on what's happening out there at the moment. Pretty interesting time. I mean, we've had some really, really strong trajectories over the last, sort of 12 months. Is there like a national? No. When we sort of look at Sydney and Melbourne together since the start of 20, we've been on a pretty strong trajectory upwards, and now we're starting to see signs of a bit of a slowdown there. So, pretty interesting time, guys. Brisbane's still going mental. But yeah, all major markets are now at a record high. So something to keep in the back of your mind. All right, guys, have a good one, and I'll see you in the next video.